Imagine this, a silent force, invisible yet ironclad, that has toppled the mightiest economic empires time and again. It's not war or famine, it's the currency they trusted most. From the sun-drenched ports of ancient trade routes to the gleaming boardrooms of today, every global reserve currency has followed a deadly playbook, crumbling after exactly 7 unforgiving stages. And right now, in 2025, as the world teeters on the edge of chaos, the US dollar, our unchallenged king, is staring down stage 5. What if I told you this isn't some wild theory? It's a blueprint etched in history, replayed 4 times over 600 years. Ignore it, and we risk everything. Buckle up. I'm about to pull back the curtain on the pattern that's devouring reserve currencies, and why yours might be next. Let's set the scene. Picture the global economy as a vast, interconnected web, trillions of dollars flowing like blood through its veins. At the heart of it all is the reserve currency. Not just any money, but the one that nations hoard in their vaults, the one that prices everything from oil barrels to gold bars, the one that settles the world's debts. When your currency claims that throne, you wield an exorbitant privilege, a phrase coined by a French economist who watched America bask in it. You print paper, endless streams of it, and swap it for real stuff, factories, oil, tech. Other countries slave away, producing goods just to earn a fistful of your dollars. You run deficits like they're going out of style because everyone needs your cash as a safety net. Borrowing? A breeze with rock-bottom rates because your bonds are the world's mattress money. It's economic alchemy, turning ink into empire. But here's the twist. That privilege is a double-edged sword. It lures you into complacency, and when the stage is hit, it cuts deep. I didn't stumble on this by accident. Digging through dusty archives and forgotten ledgers, I traced the ghosts of currencies past. The Portuguese real, the Dutch guilder, the British pound. Each rose like a phoenix, only to burn out in the same sequence. Portugal's real lit the fuse in the 15th century, dominating for 8 decades before vanishing. The guilder picked up the torch in the 1600s, ruling another 80 years until it flickered out. Britain's pound sterling held sway for over a century, from the Napoleonic Wars to the Roaring Twenties, then crashed. And the dollar? It ascended in 1944 at Bretton Woods when the world rebuilt on American terms. That's 81 years and counting. 4 cycles, 6 centuries, one inevitable path. They all thought they were invincible. We do too. But the math doesn't lie. To unravel this, we need to walk the 7 stages. The rise, the rot, the ruin. I'll weave in the stories of those who came before, showing how empires sowed their own downfall. And as we go, keep your eyes on the dollar. It's not at the peak anymore. It's sliding into the danger zone, stage 5, where the cracks widen and the wolves circle. Stage 1, the iron fist of conquest. It always starts with raw power, not just armies, but mastery over the arteries of trade. Empires don't earn reserve status through clever spreadsheets. They seize it with steel and sails. Flash back to the 1400s. Portugal, a scrappy kingdom on Europe's edge, cracks the code of the seas. While rivals cling to leaky coastal routes, Portuguese explorers like Vasco da Gama slice through uncharted waters, skirting the African Horn to tap Asia's riches. By 1498, they're not just sailing, they're enforcing. Armed caravels patrol the spice lanes, turning the Indian Ocean into a Portuguese toll road. Forts sprout like thorns. Hormuz guarding the Persian Gulf, Goa strangling Indian ports, Malacca choking the strait. Want silk or cloves? Pay in reais or face the broadsides. It's not gold that backs the real. It's gunpowder. Merchants from Lisbon to Jakarta stockpile it because bypassing Portugal means sinking your ship. Within decades, the real becomes the lifeblood of trade, a currency born of blockade and bravado. The Dutch inherit the blueprint in the 17th century, turning commerce into conquest. Their East India Company isn't some merchant guild. It's a proto-corporation with private fleets and armies, 50 vessels strong, crewed by 25,000 mercenaries. They storm Portuguese outposts, claim the Nutmeg Islands of Indonesia, and crown Amsterdam the world's bourse. Dutch frigates shadow Baltic timber routes and Atlantic convoys, demanding guilders for passage. Trade without them? Forget it. Your cargo's fair game. The guilder surges as the coin of the confident, fueled by naval might that strangles competitors. Britain amplifies this in the 19th century, building an empire where the sun never sets, and neither does their grip. The Royal Navy swells to 900 ships, dwarfing all rivals. They lock down Gibraltar's gateway, the Cape's windswept tip, Singapore's harbor. Every choke point pulses with Union Jacks. The Opium Wars pry open China. The Suez Canal becomes their vein. Pounds flow as the price of passage, backing an industrial juggernaut. No trade escapes without Sterling's stamp. America? We scripted our own version post-1945. World War II leaves Europe in ruins. We emerge unscathed, factories humming. The U.S. Navy, 11 carrier strike groups, a floating fortress, patrols from the Pacific to the Persian Gulf. Bases dot the map. Diego Garcia in the Indian Ocean, Bahrain at Hormuz, Diego Garcia shadowing Malacca, Panama's Canal, ours to toll. It's not defense, it's dominion. Dollars demand fealty, pricing swift transactions and OPEC oil. We're in stage one no more, we've long passed it. But that early power planted the seeds of what's unraveling now. Transitioning seamlessly, as dominance fades, stage two ignites. The golden age of expansion. With trade routes secured, the empire floods the world with its currency, sparking an economic supernova. Investment pours in. Colonies multiply. Portugal's real finances armadas that circle the globe, funding sugar plantations in Brazil and gold hunts in Africa. Wealth cascades. Lisbon swells with palaces, merchants mint fortunes. The reals everywhere, from African slave markets to Asian bazaars, oiling a boom that lasts decades. The Dutch ride this wave harder, their guilder greasing the gears of a tulip-fueled frenzy and Baltic grain empires. Amsterdam's exchange hums, stocks soar, the first true global market. Britain's pound? It bankrolls the railroads snaking across India, the cotton mills of Lancashire, the rubber barons of Malaya. London becomes the money vortex, sucking in capital from Cairo to Calcutta. For the U.S., the 1950s and 60s are our echo. The Marshall Plan rebuilds Europe on dollar terms. Bretton Woods pegs currencies to us. The petrodollar deal with Saudi Arabia locks oil in greenbacks. We export inflation, import prosperity, GNP skyrockets, suburbs sprawl. It's euphoria, the high before the hangover. But here's where the intrigue builds. Stage 3. The seeds of overreach. Privilege breeds excess. You start spending like the rules don't apply, piling debt on colonies and cronies. Portugal overextends, sinking reais into endless voyages and bribes to Asian sultans. Wars drain the coffers. Inflation creeps as they print to pay. The Dutch chase monopolies too far, their company bloating with corruption. VOC officials skim spice profits. Guilders lose luster amid scandals. Britain, drunk on imperial pomp, borrows wildly for Boer wars and naval arms races, sterling strained by gold outflows. America mirrors it now, deeper into Stage 3's shadow. trillions in deficits since the 70s. Vietnam, Great Society, endless wars. We print to fund it all, exporting dollars via treasury bonds that foreigners gobble up. But the pile grows. $35 trillion national debt in 2025, interest payments rivaling defense budgets. It's not sustainable. Cracks form in the facade. Now the suspense ratchets up. Stage 4, the rivals whisper. Challengers emerge, nibbling at your edges. No empire falls alone. Pretenders test the throne. For Portugal, Spain rises with New World silver, flooding markets and diluting the real. The Dutch face English privateers, then French ambitions, guilders sidelined as alliances shift. Britain's pound wobbles as Germany's mark industrializes. America's factories hum post-WWI, and colonies chafe under reparations. The dollar? We're feeling the sting acutely. China's yuan creeps into Belt and Road deals, pricing African minerals. Russia's ruble swaps with India, bypass SWIFT. BRICS nations hoard gold, not treasuries. Crypto whispers of decentralization. CBDCs from Europe challenge dollar hegemony. In 2025, with U.S. sanctions backfiring, pushing Iran and Venezuela into WAN orbits, Stage 4 bites hard. Trade wars with Beijing expose vulnerabilities. De-dollarization murmurs grow from Davos to Dubai. And this leads us inexorably to Stage 5, the crisis of confidence. The pivot where the illusion shatters. Your currency, once sacred, starts to stink of desperation. Inflation surges as printing presses overheat. Allies defect. Portugal hits this in the late 1500s. Spanish absorption, failed invasions, hyperinflation from debased coinage. Reais plummet. Trade flees to Dutch ports. The guilder cracks in the 1700s amid Anglo-Dutch wars. Bubbles burst. Confidence evaporates as Britain enforces navigation acts. Sterling's turn comes post-WWI. Gold standard abandons. 1931 crisis sees pounds devalued. Empires unravel. Here's the gut punch. We're here. In 2025, the dollar teeters in Stage 5. Post-2022, inflation peaked at 9%. Fed hikes crush growth, yet deficits balloon. Foreign holders, Japan, China, dump treasuries, yields spike. Geopolitical fractures, Ukraine war accelerates ruble-yuan trades. Middle East tensions threaten petrodollars. Public debt hits 130% of GDP. A single downgrade from Moody's could unleash panic. It's not collapse yet, but the whispers are roars. Central banks diversify. Euro, WAN, even Bitcoin in the mix. The exorbitant privilege? It's eroding, fast. Escalating further, Stage 6 looms. The desperate grasp. Empires claw back, imposing controls, igniting wars to reclaim glory. Portugal lashes out with armadas against the Ottomans, but it bankrupts them. Dutch fleets duel Britain in quagmires like the Fourth Anglo-Dutch War, guilders worthless in the wreckage. Britain clings with imperial preference tariffs, Suez invasions, but Suez 56 backfires, accelerating decolonization and sterling slide. For us, watch for it. Tariffs on China, sanctions webs, maybe proxy conflicts to safeguard the dollar's throne. But history screams. It accelerates the end. In 2025, with elections polarizing and AI disrupting jobs, the grasp tightens. Digital dollar pilots, capital controls floated. Urgency mounts. The system's fraying. Finally, Stage 7, the fall. The curtain drops. Currency demonetized. Empire fragments. Portugal's real fades by 1600, absorbed into Habsburg realms. Guilder yields to pound by 1700s. Sterling, post-Bretton Woods 71. Nixon shock limps as a relic. Trade reroutes, power shifts. The dollar's end? Not tomorrow, but the pattern points there. If we hit stage 7 by 2030s, expect chaos. Hyperinflation, asset grabs, new reserve contenders like a yuan digital hybrid, global trade stalls, recessions cascade. So why does this matter now in 2025? Because we're at the inflection. Climate shocks, AI upheavals, debt ceilings, all amplify the risks. Your 401k, mortgage, grocery bill, tied to the dollar's fate. If stage 5 deepens, inflation reignites, savings evaporate, but awareness is power. Diversify, gold, foreign assets, skills over fiat. History isn't destiny, it's a warning. We've seen the pattern 4 times. Will we break it or join the ghosts? The choice is ours, but time's ticking. Subscribe for more revelations. The financial world's darker secrets await. What stage do you see coming next? Drop it in the comments. The U.S. Navy dominates every ocean. 11 aircraft carrier battle groups, more than the rest of the world combined. The U.S. controls or has bases near every critical trade choke point. Hormuz, Malacca, Suez, Panama, Bab el-Mandeb. This isn't about defending America. What if I told you it's a blueprint for something far bigger? A shadow strategy that's locked the United States into an unbreakable grip on the world's wealth? Picture this. In 2025, as stock markets flicker and supply chains teeter on the edge of chaos, the real power isn't in boardrooms or cryptocurrencies. It's in the invisible currents of global trade, flowing under the watchful eye of American might. But here's the hidden warning. This control isn't eternal. History whispers that every empire that mastered the seas eventually wakes up to a nightmare of its own making. Today, I'm pulling back the curtain on the 3-stage formula that's turned nations into superpowers and now threatens to unravel the dollar's throne. Buckle up, because what you're about to hear could rewrite how you see your next paycheck. Let's start at the heart of it, the iron law of economic empires. Controlling the arteries of world commerce isn't just a perk of naval supremacy. It's the foundation. Back in the fog-shrouded dawn of exploration, tiny Portugal cracked the code. By the early 1500s, their caravels weren't just ships. They were harbingers of fortune. Sailing the uncharted routes to India and beyond, the Portuguese didn't conquer lands outright. They seized the waves. Spices from the Malabar coast, silks from China, porcelain gleaming like captured stars, all funneled back to Lisbon on winds they commanded. European rivals? They paid tolls in gold to pass through Portuguese-guarded straits. It was a velvet-glove stranglehold, ensuring no cargo crossed the Atlantic or Indian Ocean without a nod from the crown. And just like that, Portugal wasn't a kingdom anymore. It was the world's banker, its ports throbbing with the pulse of global exchange. But dominance like that demands more than swords and sails. It requires a machine to harvest the riches. Enter the second act, the alchemy of trade surpluses. Once you've bottled the sea lanes, the world becomes your marketplace and you tilt the scales in your favor. I want you to imagine Amsterdam in the 1600s. Not the quaint postcard city, but a buzzing hive of avarice and ingenuity. The Dutch East India Company, that behemoth of early capitalism, turned the city into a vortex. Ships from Java arrived laden with pepper and nutmeg, bought dirt cheap in humid bazaars. Those same vessels returned with woolens from England and furs from Russia, flipped at premiums that would make today's hedge fund managers blush. It wasn't plunder, it was precision. The Dutch arbitraged the globe, low in Batavia, high in Baltic ports, pocketing the difference like clockwork. Wealth piled up. Mansions rose along the Herengracht canals, their facades dripping with marble imported on the very profits they generated. The city's trade ledger showed surpluses so vast that taxes, obsolete. The Republic ran on commerce alone, a self-sustaining engine that made Dutch merchants lords over kings. Now, fast forward to the smoke-choked factories of 19th century Britain where the formula hit its stride on an industrial scale. The British Empire wasn't subtle, it was symphonic. Controlling choke points from Gibraltar to Singapore, they exported the fruits of the machine age, textiles woven in Lancashire mills, ironclads forged in the Clyde, locomotives that shrunk continents, raw inputs, sucked in at bargain rates, Egyptian cotton, Indian tea, Brazilian rubber, all priced by London syndicates that set the rules of the game. The surplus, titanic. By the 1870s, Britain's coffers overflowed, funding railways across the empire and beyond, while the city of London became the nerve center of capital, dwarfing Paris and Berlin. It was the golden age of Pax Britannica, where a nation's factories didn't just build goods, they built an unassailable fortress of wealth. But even then, cracks were forming. Empires don't stay lean forever. Here's where the intrigue deepens and the suspense builds. The United States inherited this playbook after the ashes of World War II settled. America emerged unscathed, its factories humming while Europe nursed wounds and Asia clawed from rubble. From 1945 to the late 1960s, the U.S. ran the most lopsided trade surplus the world had ever seen. Jeeps, radios, chemicals, and steel poured out to rebuild shattered allies, Marshall Plan aid wrapped in export deals. Dollars cascaded overseas, piling into foreign vaults, while Fort Knox glittered with over 20,000 metric tons of gold, a hoard that eclipsed the planet's rest. It was stage 2 in overdrive, advantageous exchange on steroids, but prosperity bred complacency. By the 1970s, American tastes shifted. Why manufacture when you can consume? Imports surged, Japanese electronics, German cars, oil from the Gulf, and the surplus flipped to a chasmic deficit. Factories shuttered in Detroit, malls sprouted in suburbs. The machine that accumulated wealth now hemorrhaged it. And that's the pivot, the turning point no one saw coming until it was too late. Which brings us to the third stage, the coronation that sows the seeds of downfall. Formalizing reserve currency status isn't a ceremony. It's a pact with the devil. When the world bows to your money, production takes a backseat to privilege. For Portugal, it crystallized around 1510. The real, minted from New World silver, became the lingua franca of trade. Asian potentates hoarded them. European courts denominated debts in them. Treaties from the Treaty of Tordesillas onward locked it in, turning Portuguese coin into the oil of commerce. The Dutch peaked mid-century, their guilder the gold standard of bills of exchange. Even rivals like the English scribbled contracts in guilders, drawn to Amsterdam's liquid markets where fortunes traded hands faster than a card-sharp's deck. Britain sealed it at the Congress of Vienna in 1815, post-Napoleon. The pound sterling wasn't just currency, it was the yardstick. The gold standard? A British invention with London dictating convertibility and flows. Global loans, from Ottoman railroads to Argentine ports, flowed in sterling, cementing an empire where money moved mountains. The U.S. scripted the most dramatic finale at Bretton Woods in 1944. Amid the pine-scented hills of New Hampshire, 44 nations gathered, exhausted by war, desperate for order. They didn't just agree. The dollar became the keystone. Pegged to gold at $35 an ounce, it anchored every other currency in a web of fixed exchanges. The IMF and World Bank rose as enforcers, ensuring the system's fidelity. It was explicit, ironclad. The world would hold dollars as lifeblood. But here's the buried truth. The one economists like Robert Triffin unveiled in 1960 that chills the spine. The Triffin Dilemma. To supply the globe with enough dollars for trade, America had to run endless deficits, export less, import more, print money to fill the gap. Your currency becomes indispensable, but your economy atrophies. Manufacturing flees to cheaper shores, debts balloon as the world recycles your IOUs back into treasuries. It's a slow poison. The reserve nation funds its excesses by borrowing from those it once outproduced. Portugal's reals flooded out, hollowing the homeland. Dutch guilders lubricated rivals' rise. Britain's pound financed its rivals' factories. And now, in 2025, the dollar? It's the undisputed king, 70% of global reserves, oil priced in greenbacks, swift networks pulsing through New York. Yet deficits yawn at $35 trillion in national debt, with China and Europe eyeing alternatives. De-dollarization whispers grow louder. BRICS summits, digital yuan trials, crypto hedges against the throne's wobble. Why does this matter now in our hyper-connected, AI-driven 2025? Because the cycle is accelerating. Supply chain snarls from Red Sea skirmishes to Taiwan tensions remind us, those choke points I mentioned earlier, they're powder kegs. If the dollar's grip slips, say through a petrodollar fracture or a multilateral reserve basket, the fallout hits everyone. Your 401k evaporates in currency wars. Inflation spikes as trade reroutes chaotically. Emerging powers like India and Saudi Arabia aren't passive. They're building parallel systems, from rupee oil deals to blockchain settlements. The U.S. Navy still rules the waves, but naval might can't print prosperity forever. Stage 3's peak is a mirage, maximum power masking inevitable erosion. We've seen it devour Portugal's age of discoveries, Dutch golden canals, British imperial sunset. The dollar's run? Unprecedented in scale, but history doesn't spare the mighty. So as I stand here in 2025, gazing at a world teetering between multipolarity and meltdown, I can't shake the reflection. Empires rise on the tides of trade, but they drown in the deficits they create. The question isn't if the shift comes, it's how we navigate it. Will the dollar adapt, or will we witness the quiet unraveling of the system that built our modern world? The seas are restless. The next voyage begins now. If this revelation has you rethinking the financial shadows, hit subscribe, because the real story of money is just unfolding. Imagine this. You're the king of the world economy, printing money that everyone craves, but deep down, you know it's a house of cards. One wrong move, and the whole system comes crashing down, not just for you, but for the entire global order. In 2025, as inflation whispers turn to shouts and trade wars brew on the horizon, we're staring at the edge of that very cliff. The U.S. dollar, the undisputed reserve king, is following a path trodden by empires before it. Welcome to the hidden underbelly of global finance, where surplus turns to deficit and prosperity flips to peril. This is the story of how reserve currencies eat themselves alive and why the dollar's fate could rewrite our economic future. Let's rewind to the heart of the dilemma we just uncovered, the Triffin trap, that cruel paradox Robert Triffin laid bare back in 1960. For the world to keep the engine of trade humming, nations need dollars flowing like rivers, reserves for stability, lubricant for deals across borders. But to flood the globe with those dollars, America has to pump them out through massive trade deficits. It's like being the generous host at an endless party, handing out "I owe us" while the guests feast on your dime. Sounds sustainable? Hold on, it's not. This forced imbalance erodes the very strength that made the dollar indispensable. You can't hoard surpluses and shower the world with currency at the same time. The math doesn't bend. It's a one-way ticket to what I call stage 4, the great reversal, where the producer becomes the consumer and the seeds of collapse are sown. Picture Portugal in the sweltering heat of the mid-1500s. Once a seafaring powerhouse, their ships dominated the spice routes, flooding Lisbon with gold and silver from distant colonies in Brazil and Africa. Trade surpluses built an empire that seemed unbreakable. But then the winds shifted. No longer content to manufacture their own goods, the Portuguese elite turned inward, indulging in the fruits of past labors. Why toil in workshops when the New World's bounty arrived by galleon? Imports surged, grain from the sun-baked fields of Sicily, fine textiles from the looms of Flanders, tools and luxuries from every corner of Europe. The surplus evaporated overnight, morphing into a yawning deficit they papered over with colonial treasure. At first, no one raised the alarm. King João III and his successors threw extravagant feasts in gilded palaces, commissioned soaring cathedrals that pierced the skies, and maintained a sprawling military to guard their far-flung domains. The gold kept coming, a glittering illusion of endless wealth. But here's the twist that history loves to hide. They weren't creating new riches, they were devouring the old ones. Palaces don't plow fields or forge steel. The empire's arteries were clogging with consumption, not innovation. By the late 1500s, the flow from Brazil began to stutter, mines depleted, routes contested by rivals like Spain and England. Portugal's leaders, blinded by the sparkle, failed to pivot. The deficit locked in, irreversible, as they lived like gods on borrowed time. Fast forward a century and a half to the misty canals of the Dutch Republic in the 1700s. The Netherlands had risen like a phoenix from the ashes of Spanish rule, their merchant fleets turning Amsterdam into the glittering jewel of Europe. For generations, they'd exported shipbuilding prowess, textiles, and herring that salted the seas, amassing surpluses that funded a golden age of art and science. But comfort is the silent assassin. With pockets full of accumulated capital, why risk the grind of factories or risky voyages? The Dutch pivoted to what seemed smarter: finance. Amsterdam's exchanges became the heartbeat of Europe's money, lending to kings and republics alike at hefty interest. It worked for a while. Passive income rolled in, funding lavish lifestyles and colonial outposts. But the trade winds reversed. No longer outproducing the world, they imported silks from the east, timber from the Baltics, and grain to feed a growing urban sprawl. The surplus flipped to deficit, financed by liquidating those hoarded treasures, selling off shares in distant trades, dipping into capital reserves. The bankers of Amsterdam grew fat on fees. But the nation's productive muscle atrophied. Factories idled, innovation lagged behind rising powers like Britain. By the mid-1700s, the Dutch were spectators in their own economy, watching as others built the future on foundations they'd once laid. The reversal wasn't dramatic. It was a slow drift into dependency, the kind that lulls you until the wake-up call. Now cross the channel to Britain at the dawn of the 20th century, where the sun famously never set on their empire. By 1900, the Industrial Revolution's forge had cooled. Once the workshop of the world, churning out steam engines, textiles, and iron that powered global progress, Britain now eyed imports with growing hunger. Food from the prairies of America and Australia, raw cotton and rubber from colonies, even finished goods eclipsing their own, from humming German machine shops and American assembly lines. The trade balance tipped into the red, deficits swelling year after year. How did they sustain it? a web of overseas investments woven over centuries of imperial reach, railroads snaking through India, gold mines in South Africa, tea plantations in Ceylon. These weren't just assets. They were a global portfolio yielding billions in returns. It was wealth extraction on a grand scale, siphoning value from the empire's edges to the heart in London. But it was illusory growth. At home, factories shuttered. Workers streamed to colonies or unemployment lines, and the industrial edge dulled against sharper competitors. Britain's leaders, much like their predecessors, mistook financial wizardry for real power. They dined on the past's dividends, blind to the hollowing out. By the 1920s, the empire strained under the weight, deficits financed by selling off jewels of the crown, literally and figuratively. And here's where the suspense builds. The United States stepped onto this same stage in 1971, the year Nixon severed the dollar's golden tether, unleashing a torrent of deficits that never looked back. Fast forward to the 1980s and the gap yawned wider. By the 2000s, it hit $800 billion annually, a chasm swallowing consumer electronics from Asia, cars from Europe, clothing from sweatshops worldwide. America, the arsenal of democracy turned superstore, imports everything under the sun while exporting paper promises. Dollars printed in Washington, shipped abroad in exchange for tangible goods. It only works because the world craves those dollars for oil trades, reserves, safe havens. But peel back the layers, and it's stage 4 in full bloom. A nation consuming beyond its means, liquidating the productivity of yesteryear through financial sleight of hand. In 2025, as supply chains fracture and de-dollarization murmurs from BRICS nations grow louder, the implications escalate like a thriller's plot twist. These deficits aren't just numbers on a ledger. They're eroding America's manufacturing base, widening inequality, and fueling a debt mountain that towers at $35 trillion. We've outsourced jobs, hollowed out the heartland, and bet everything on the dollar's throne. But history whispers a warning. Every reserve before us reached this reversal and none escaped unscathed. The U.S. funnels dollars out, but what happens when trading partners say, enough? When China hoards gold or Europe pushes the euro harder? The financial system teeters, and the urgency hits home. Your retirement, your groceries, your country's edge in a multipolar world all hang in this balance. As the deficits mount, desperation breeds the final act. Stage 5, the debasement dance. When borrowing hits its limit and the party thins, nations turn to the printing press, diluting their currency like counterfeiters in the night. Portugal felt it first in the 1550s as colonial gold faltered. King Sebastian's court, squeezed by endless wars and imports, began shaving silver from the real coinage. They minted more money with less backing, a sneaky inflation that crept through markets. Prices for bread and spices doubled, then tripled. Merchants grumbled, then revolted, hoarding goods or demanding payment in foreign coin. By the 1570s, the real was a shadow of itself, shunned in international ports. Lisbon's traders, once masters of the seas, watched rivals like the Dutch swoop in, trading in stable guilders. The Netherlands stumbled into the same trap by the 1720s. Their guilder, once a beacon of sound money backed by Amsterdam's vaults and prudent banks, faced the crush of wars against France and a crumbling empire. Government debt soared. Lenders demanded sky-high rates, so they printed, flooding the economy with guilders unmoored from real value. Inflation gnawed at savings, eroding the trust that had made Dutch finance invincible. By the 1780s, as revolutionaries stirred across Europe, the guilder lost its luster. Trade shifted to pounds and francs. Amsterdam's exchanges dimmed, the Republic reduced to a financial relic. Britain's descent was forged in the fires of 2 world wars, the ultimate stress test. World War I shattered the gold standard. The Bank of England printed pounds like ammunition, flooding trenches and home fronts. They clawed back to gold in 1925 at an absurdly high peg, starving the economy of credit and sparking the Great Depression's bite. World War II sealed the fate. Off gold forever, the pound floated into devaluation's abyss. Post-1945, Reconstruction and the welfare state's cradle demanded more printing. Devaluations in 1949 and 1967 sliced the pound's value by 30% each time, importing inflation that haunted generations. Britain's global clout withered. By the 1970s, the IMF bailed them out, a stark reminder that even empires print their way to irrelevance. Today, in 2025, the dollar dances on this knife's edge. The Fed's balance sheet balloons past $7 trillion. Quantitative easing, a polite term for debasement. Inflation isn't just a blip. It's the symptom of deficits too vast to borrow against. We've seen the pattern. Portugal's gold rush to ruin. The Dutch financiers' fade. Britain's imperial unraveling. The U.S. exports dollars for goods, but as trust phrase, with crypto challengers rising and central banks diversifying reserves, the slide accelerates. Will we debase outright, igniting hyperinflation, or muddle through, prolonging the agony? The reflection cuts deep. Reserve currencies don't fall in a blaze. They wither from within, consumed by the very abundance they provide. In this global game, no empire lasts forever, but awareness is our weapon. As we navigate 2025's uncertainties, geopolitical storms, tech disruptions, climate reckonings, question the system. Diversify your bets, build real skills, and remember, the dollar's crown is heavy, and history never forgives the complacent. What stage are we truly in? The answer might just save you. Imagine this. It's 2025 and the world's financial backbone, the US dollar, is starting to creak under the weight of its own excess. Trillions pumped into the system like digital adrenaline, but instead of revival, it's seeding a quiet revolution. What if I told you that every empire's currency has followed the same deadly path and we're staring down the barrel of it right now? The signs aren't hidden in dusty history books. They're flashing in boardrooms, central banks, and your daily inflation bill. Buckle up, because I'm about to pull back the curtain on how reserve currencies die, and why the dollar's clock is ticking louder than ever. Let's rewind just a bit to set the stage. We've been tracing the British pound's slow bleed after World War II. By 1945, it was adrift, no longer tethered to gold, hemorrhaging value as Britain fired up the printing presses to stitch together a shattered economy and build that grand welfare dream. Devaluations hit like aftershocks. In 1949, then again in 1967, each one chipping away at the trust that once made the pound the world's safe harbor. International players watch their holdings evaporate and whispers turn to action. Why bet on a currency that's folding under its own debt? By the 1970s, the pound wasn't even pretending anymore. It had slipped from global reserve kingpin to a humble regional player used for local trades but dismissed for anything bigger. The world had moved on, eyes locked on a new contender across the Atlantic. But here's where the real intrigue begins. The hidden mechanics that doom these giants aren't accidents. They're stages, predictable as a thriller plot, etched into centuries of financial history. And the US dollar? It's barreling through them faster than you might think. Picture the shift to America in the mid-20th century. Bretton Woods in 1944 crowned the dollar as the new gold standard proxy, backed by Fort Knox and U.S. might. For decades it held firm. Global trade, oil deals, reserves, all funneled through Uncle Sam. But cracks form when complacency sets in. Enter stage 5, the great debasement, where faith starts fraying not from sneaky coin clipping like in ancient Rome, but from modern fiat wizardry. The U.S. hit this wall in 2008 when the housing bubble burst and the financial crisis clawed at the edges of the global order. I remember poring over the Fed's reports that year, the sheer audacity of it all. The Federal Reserve didn't just intervene, it unleashed quantitative easing, a polite term for conjuring money out of thin air. From 2008 to 2014, they minted $3.5 trillion, flooding banks, markets, everything in sight. It stabilized the ship, sure, but at what cost? Then COVID crashed the party in 2020 and the spigots opened wider. Another $7 trillion by 2022. The U.S. money supply ballooned faster than during any peacetime surge in history. This isn't growth, it's dilution. The dollar's buying power? It withered. Inflation roared back in 2021 and 2022, spiking to 40-year highs, 9% plus in some months, eroding savings, jacking up grocery bills, and making millionaires feel like they're treading water. But the U.S. twist on this tale? Scale. The dollar isn't just America's currency. It's the world's lifeblood. When the Fed prints, it doesn't stay contained. It exports the inflation like a virus. Emerging markets holding dollar reserves see their stashes lose punch overnight. Their dollar-denominated debts get a breather, easier to pay back in weaker greenbacks, but imports from the U.S.? They skyrocket in cost, everything from machinery to medicine. It's a global squeeze and resentment builds. Confidence? That's the first domino to tip. Once it wobbles, stage 6 looms. The desperate hunt for alternatives. The breaking point where trust shatters and the exodus begins. History whispers warnings here, loud and clear if you're listening. Take Portugal in the 1570s, a seafaring powerhouse whose reel once ruled trade routes from Lisbon to the Indies. But endless wars and Asian adventures drained the coffers. They debased relentlessly, flooding the market with lighter coins. By the late 1570s and into the 1580s, the smart money, international merchants, smelled the rot. No more reals for payment. They demanded Spanish silver or Venetian ducats instead. Trade pacts, denominated in rivals' currencies. Even loyal Asian traders who'd hoarded reals for generations started balking, refusing them outright or insisting on heaps more to offset the devaluation. When Spain swallowed Portugal whole in 1580, the real was already a corpse. Markets had voted with their feet long before the ink dried on the annexation papers. Fast forward to the Dutch guilder, the 18th century wunderkind born from tulip mania and spice trade fortunes. Amsterdam was the money magnet, pulling in reserves from across Europe. But imperial overreach, wars with England, France, piled on debt, and debasement crept in. By the 1700s, the guilder's shine dulled. Rival powers like the French and British started stashing their wealth elsewhere. Trade flowed smoother in other coins. Come the 1780s, Amsterdam's throne was toppled. London had seized the crown as Europe's financial heartbeat. The guilder lingered for neighborhood deals, but on the world stage, forgotten. The fall was a slow burn, but once lit, no extinguishing it. Now the British pound's swan song, post-1945, a masterclass in rapid unraveling. War left Britain buried in debt, owing billions to the U.S. and allies. The pound, propped up artificially, was a house of cards on American loans. Then in 1949, the hammer fell, a 30% devaluation overnight. Holders worldwide woke to a third of their wealth vanished. Poof. Trust annihilated. Nations scrambled, dumping pounds for dollars in a frenzy. By 1960, the pound's global reserve slice had plummeted from over 60% in 1945 to under 20%. In just 15 years, the empire's currency was dethroned, not by decree, but by cold market logic. These aren't isolated fables. They're blueprints. And today, in 2025, the dollar's threading the needle of stage 6. The signals are screaming from every corner. Back in the 2000s, China and Russia kicked off the quiet rebellion, slashing dollar reserves and snapping up gold, thousands of tons. China's official holdings? More than doubled since 2010, but insiders whisper the real stash dwarfs that. Russia? Post-2014 sanctions, they dumped nearly all U.S. treasuries, pivoting to anything but dollars. The BRICS crew, Brazil, Russia, India, China, South Africa, has been buzzing about ditching the dollar for intratrade. In 2023, they floated a BRICS currency idea. It's not live yet, but the mere whisper sends shivers through Wall Street. Even the petrodollar fortress is cracking. Saudi Arabia, locked into dollar oil pricing since 1974, the bedrock of U.S. dominance, started taking yuan for sales to China in 2023. 50 years of precedent broken. Central banks worldwide are playing diversifiers roulette. The dollar's share of global reserves dipped from 72% in 2000 to 58% by 2024. 14 points might sound tame, but that's trillions fleeing to euros, yuan, and that timeless hedge, gold. Tiny players aren't sitting idle either. Thailand, Malaysia, Indonesia. They're inking deals to settle trade in local currencies, bypassing the greenback entirely. This isn't anti-American spite, it's survival instinct. Nations see the echoes, U.S. deficits ballooning endlessly, debasement on steroids, purchasing power circling the drain. They're not waiting for the full collapse, they're hedging bets now, building escape hatches before the fire spreads. And as Stage 6 intensifies, we edge toward the finale. Stage 7, the replacement and the fall. This is the end game, where markets crown a successor without fanfare or treaties. The old guard fades as the new one rises through sheer adoption. Traders, banks, governments voting with every transaction. For Portugal's real, it was the Spanish silver peso that stepped up in the late 1500s. Spain's conquests unlocked America's silver veins, Potosi in Bolivia, Zacatecas in Mexico, churning out more bullion than the planet had ever seen. That flood of real wealth, not paper promises, lured the world away from the dying real. Trade routes realigned, reserves shifted, and the Portuguese era closed with a whimper. So where does this leave us in 2025? The dollar's not toppling tomorrow, no dramatic crash reel, but the momentum's building, a subtle shift gathering speed like a gathering storm. Gold's glittering allure, the yuan's quiet rise, maybe even crypto shadows or a BRICS wildcard. These are the contenders circling. For everyday folks, it means volatility ahead, higher costs, shakier savings, a world where the dollar's grip feels less like security and more like a fading echo. I've chased these threads through archives and headlines, and the pattern's unbreakable. No reserve currency lasts forever. Empires rise on innovation and trust, but they fall on excess and doubt. The U.S. has powered the globe like no other, lifting billions in the process, but ignoring the debasement diary. That's playing with fire. Watch the reserves, track the trades, and ask yourself, are we spectators or shapers of what's next? The markets don't forgive the blind. Stay vigilant, because the next chapter's already writing itself. Imagine this, You're standing on the edge of a financial cliff, watching the world's most powerful currency teetering toward the abyss. For decades, the US dollar has been the unchallenged king of global trade, the lifeblood of economies everywhere. But what if I told you history whispers a chilling warning that every empire's money has fallen before, and the dollar's throne is cracking right now? In 2025, as tensions simmer across continents and central banks scramble, the signs are unmistakable. We're on the brink of the greatest monetary shift since World War II, and if you don't see it coming, your savings, your future, everything could vanish in the storm. Let me take you back, not to dusty textbooks, but to the shadowy undercurrents of power that have reshaped the world time and again. It all started in the late 1500s, when the Portuguese real, once a symbol of exploration and wealth, faded into obscurity. As I mentioned earlier, Spain's conquest of colossal silver mines in the Americas, like Potosi in Bolivia and Zacatecas in Mexico, flooded the world with more silver than had ever been imagined. Those gleaming coins didn't just enrich kings, they rewrote the rules of trade. Picture the bustling ports of Lisbon and Seville. Spanish silver pesos, uniform and endlessly supplied, began infiltrating every corner of commerce. They were reliable, backed by the raw force of imperial extraction, millions of tons pulled from the earth by desperate labor. Merchants, those savvy operators who thrived on certainty, turned their backs on the Portuguese real. It was tainted, diluted by overprinting and wars, its value eroding like sand through fingers. Over 2 grueling decades, the shift unfolded, alliances fractured, trade routes realigned, and by 1600, the real was a relic, a footnote in history's ledger. The peso. It became the first true global currency, the standard that oiled the wheels of empire from Manila to Mexico City. But nothing lasts forever in the game of money and might. Fast forward to the late 1700s, and the Dutch guilder, born from the golden age of trade and innovation, faced its own unraveling. Amsterdam was the beating heart of finance, its stock exchange a marvel of liquidity, funding voyages that spanned the seas. Yet as Britain's industrial fires roared to life, belching steam and steel from factories that churned out goods the world craved, the guilder began to wane. Britain's navy, that iron-clad guardian of the waves, patrolled the trade lanes with unyielding dominance, ensuring safe passage for its merchants. I can almost hear the whispers in smoky coffee houses. Why cling to the guilder when the pound sterling promises stability, backed by an economy that's not just trading spices but manufacturing the future? London's markets deepened, drawing capital like a magnet, deeper pools of money, faster flows, less risk. The transition wasn't swift. It stretched over 3 decades of skirmishes and economic maneuvering. By 1815, in the smoke of Napoleon's defeat at Waterloo, the pound had ascended. The guilder? It shrank to a regional whisper, echoing in the canals of a fading republic. Britain's edge wasn't luck. It was the fusion of productive might, military muscle over vital roots, and a currency that mirrored that strength. Now let's pull the veil further. The 20th century brought the pound's own dramatic fall, eclipsed by the unyielding rise of the US dollar. World War II left Britain a hollow shell, its coffers drained, its empire crumbling under the weight of debt. Across the Atlantic, America emerged unscathed, its factories humming, its vaults brimming with 2/3 of the planet's gold reserves. In the hallowed halls of Bretton Woods in 1944, the world bowed to this reality. The dollar would anchor the global system, convertible to gold at a fixed rate, a beacon of post-war reconstruction. but the handover lingered, a slow bleed from 1945 into the 1960s. The pound staggered through devaluations, first in 1949, slashing its value by 30% overnight, then again in 1967, as Britain's economy choked on strikes and stagnation. Families watched their life savings dissolve, pensions turning to dust. By then, the dollar was supreme, fueling the American century with its unmatched industrial base and the military projection that secured oceans of trade. The pattern was crystal clear. Reserve currencies don't fade quietly. They collapse under the strain of overextension, replaced by the power that commands production, surplus, and sea lanes. And here we are in the shadow of that same cycle. The dollar's dominance, forged in the fires of victory, now strains against cracks we can't ignore. Debt mountains tower at unsustainable heights. Endless wars drain reserves, and rivals circle like wolves. So what emerges from the ruins? History's ghosts offer tantalizing clues, but the future twists in uncertainty. We're deep in what I call Stage 6, the frantic hunt for alternatives. Yet Stage 7, the decisive replacement, looms just beyond the horizon. Consider the contenders. China, with its colossal trade surpluses and factories that supply the world, seems a natural heir. Yet its yuan remains shackled by capital controls, a currency you can't freely shuttle across borders without Beijing's nod. No reserve status there, not when trust demands openness. Military might? China's navy grows, but it doesn't yet command the choke points like the Strait of Malacca or the Panama Canal. Then there's the euro, holding court as the second most coveted reserve. Europe's a patchwork powerhouse. Germany's engines of precision engineering contrast sharply with the Mediterranean's fiscal frailties. An aging populace saps vitality. Energy dependence leaves it vulnerable to whims from Moscow or the Middle East. And without a unified budget, it's a house divided. The euro endures, but it fractures under pressure. Gold glimmers as an ancient sentinel, with central banks hoarding it at levels unseen since the 1970s. It's incorruptible. No central printer can inflate it away. But scale it? Impossible. There's finite supply to back quadrillions in trade. It can't grease the gears of daily deals without sparking chaos. Whispers of a basket currency swirl too. The IMF's special drawing rights, a cocktail of dollars, euros, yuan, yen, and pounds. Neutral perhaps, but bureaucratic and slow. Or technology's wild card. Digital realms where algorithms or commodities underpin new monies. Bitcoin evangelists dream of a decentralized dawn, but governments, guardians of sovereignty, won't surrender the reins lightly. Expect pushback, regulations, maybe outright bans. The truth? No single titan rises yet. The likeliest path is turmoil, a multipolar maze where currencies clash in regional fiefdoms. Dollars dominating the Americas, euros binding Europe, yuan anchoring Asia's Silk Roads, gold as the neutral arbiter for interblock settlements. It's not elegant. It's a brawl. Exchange rates whipping like flags in a gale, trade wars igniting, markets convulsing. History's transitions were never tidy. They were born in volatility, the forge of new orders. But why does this grip you? The everyday investor, the family budgeting for tomorrow. Because these aren't abstract tides. They're tsunamis crashing into your life. I've seen the echoes in every downfall. In Portugal's twilight, the real's demise plunged the empire into depression. Merchants, once flush with East India's profits, awoke to vaults of worthless metal. Their livelihoods evaporated, sparking riots and ruin across colonies. The Dutch saw their middle class shatter as the guilder yielded. Amsterdam's burghers, proud holders of annuities and shares, watched fortunes melt in the 1780s crash, fueling a century of decline. Post-war Britain, a generation's dreams deferred, the 1949 devaluation hit like a thunderbolt. Savings halved, bonds betrayed, retirees scraping by as rationing lingered. By 1967, another plunge sealed it. The pound, once imperial, became a cautionary tale. We're living America's slow unraveling now. Since 2020, inflation has clawed away 25% of the dollar's punch. Your grocery bill up, your nest egg shrinking. Paychecks stretch thinner, homes cost fortunes, retirements feel like gambles. This is stage 6's grind, but acceleration beckons. De-dollarization whispers from brick summits, nations hoarding gold, crypto hedges blooming. If the arc holds, the 2030s could unleash stage 7, a crisis point where the dollar plummets 50% in months, as the pound did in '49. Borders tighten, imports soar in price, pensions wither. It's not hyperbole, it's pattern. So what armor do you forge? First, awaken to the risk. Dollars aren't sanctuary, they're exposed. Diversify beyond fiat. Gold's timeless shield. Foreign assets unyoked to Uncle Sam. Skills that trade in any currency. Hedge with real yields. Land, commodities, equities, and rising powers. And stay vigilant. Knowledge is your edge in this fog. As we stand in 2025, the financial stars realign. The dollar's saga isn't ended, but its chapter closes. Empires rise and fall, currencies with them, but the resilient adapt. Will you be the merchant who saw the silver tide coming, or the one left clutching faded coins? The choice is yours before the wave breaks. Imagine this. You're staring at your bank account, convinced the dollars inside are your fortress against uncertainty. But what if I told you that fortress is cracking right now, and the ground beneath it is shifting faster than anyone admits? In the shadows of global finance, a silent revolution is underway, one that could wipe out half your savings overnight just like it did to the British pound back in 1949. And the US dollar? It's next in line. We've seen the warning signs, the creeping loss of its crown as the world's reserve currency. But what if I revealed the escape plan that's kept the savvy alive through centuries of monetary mayhem? Stick with me, because what comes next isn't just theory, it's your financial survival guide. Let's pull back the curtain on the situation we're facing today. Picture the year 2025. Economies are interconnected like never before, with supply chains snaking across continents and digital ledgers tracking trillions in trades every second. The dollar has been the undisputed king since the smoke cleared after World War II. Oil barons pricing their black gold in greenbacks, central banks hoarding it like treasure. But kings fall. And right now, as I speak, that fall is picking up speed. It's not some distant storm, it's the wind rattling your windows. Holding pure dollars? That's not security. It's a gamble on a currency that's bloating with debt and deficits, eroding trust, one printed bill at a time. To grasp why this is happening, we need to dive into the hidden machinery of empire currencies, the ironclad patterns that have toppled giants before. History isn't a random reel of events. It's a blueprint etched in gold and ink. Every dominant currency follows a predictable arc, a 7-stage saga of rise, peak, and ruin. We're not talking fairy tales here. This is cold, hard mathematics, the kind that doomed Portugal's real in the 1500s, the Dutch guilder's golden era in the 1700s, and the British pound's imperial reign by the early 1900s. These weren't flukes. They were formulas. Explosive growth fueled by innovation and conquest, followed by overreach, endless borrowing, currency flooding to paper over cracks, and allies quietly shopping for alternatives. Take the Portuguese real, born from the spice trades and age of discovery around 1450. For 8 decades, it ruled sea lanes from Lisbon to the Indies, backing explorers who redrew the world map. But then came the strain. Wars drained the coffers, silver inflows slowed, and rivals like Spain started whispering about a better bet, their own metal-backed coinage. By 1530, the real was a shadow, devalued and discarded. Fast forward to the Dutch guilder, Amsterdam's lifeblood from 1640. Those tulip-mad traders built a financial web that financed half of Europe's wars, but hubris crept in, speculative bubbles, colonial overstretch, and a navy that couldn't keep pace with Britain's. 80 years later, in 1720, it cracked, confidence evaporated, and wealth fled to London. The British pound? That's the one that hits closest to home. From 1815, after Napoleon's defeat, it lorded over an empire where the sun never set. Railroads, factories, colonies, the pound oiled it all. But by the 1920s, 2 world wars had bled it dry, deficits ballooned, and gold convertibility became a pipe dream. In 1949, the ultimate humiliation, a 30% devaluation against the dollar, sparking inflation that ravaged savers. Each cycle, roughly 80 to 110 years of dominance, give or take. And the dollar? It seized the throne in 1944 at Bretton Woods, when 44 nations pledged allegiance. That's 81 years ago. Do the math. We're smack in the late-stage danger zone, mirroring every symptom: trillion-dollar deficits, money printers running hot, and a chorus of nations eyeing yuan, euros, or even crypto as escape hatches. Now let's escalate this. What happens when the pattern accelerates? We're witnessing stage 5 bleeding into 6, the erosion of trust, where dollar holdings in foreign vaults start trickling out, then pouring. But unlike those old regional tumbles, this one's a global earthquake. The dollar isn't just America's money, it's the world's plumbing. Over $70 trillion in bonds float out there, from Brazilian farms borrowing for soy exports to Chinese firms hedging tech deals. Oil, priced in dollars. Gold, dollars. Even your morning coffee chain's supply chain runs on dollar swaps. When reserve status slips, and it's slipping with BRICS nations testing non-dollar trades, the ripple isn't a wave, it's a tsunami. Central banks are already quietly diversifying. Russia's ditching dollars for rubles in energy deals. Saudi Arabia's flirting with yuan for oil. Gold prices? They're spiking not because of jewelry trends, but because smart money smells fiat fear. And the debt bomb? Emerging markets owe trillions in dollar loans. A devaluation hits, and repayments skyrocket in local terms. Defaults cascade. Corporations fold. Banks seize up. Pensions vaporize. Developed economies aren't safe either. Their dollar-stuffed reserves turn toxic. Balance sheets shatter like glass. This isn't a tidy handover like pound to dollar post-World War II. No single heir apparent waits in the wings. China's yuan? Hamstrung by capital controls. The euro? Fractured by politics. The shift? Chaotic, convulsive, rewriting trade rules, inflating everything from groceries to mortgages. Why does this matter right now in 2025? Because the acceleration is here. We're not debating hypotheticals. Indicators are flashing red. Track central bank reports. Dollar shares in global reserves dipped below 60% last year, the steepest drop since the 90s. Watch trade pacts. India and Malaysia just inked rupee deals bypassing Uncle Sam. Gold's hovering near records, a canary in the coal mine for fiat flight. And domestically, U.S. debt clocks $35 trillion, with interest payments rivaling defense budgets. Politicians promise growth, but the math mocks them. Deficits aren't shrinking, they're exploding. Democracies crave the easy path, stimulus checks over austerity, short-term highs over long-haul fixes. Reversing this? It'd demand slashing spending, hiking taxes, rebuilding factories from rust, pain that voters punish at the ballot box. History shows no empire pulled it off. The pattern marches on. So where does that leave you and me? This isn't a call to arms against Washington or a partisan rant. It's a wake-up to the inexorable math that felled the mighty before. The dollar's in Stage 5's twilight, edging toward 6's storm. Stage 7, full replacement, looms 10 to 20 years out, maybe sooner if tensions boil over, like a Taiwan flare-up or endless Ukraine aid. But sooner could mean months for shocks, years for the full unraveling. Don't mishear me, I'm not prophesying Armageddon tomorrow. The U.S. won't crumble into Mad Max chaos. Planes will fly, stores stay open. But wealth, that's the casualty. Pure dollar holdings become anchors in a sinking ship. The antidote? Position yourself like the survivors of old. First, diversify. Smartly, surgically. You can't ghost dollars entirely if you're stateside. Rent, taxes, daily life demand them. But cap your exposure. Pivot to assets that laugh at currency chaos. Tangible stuff with intrinsic punch. Real estate, properties that generate rent, shielding against inflation. Productive ventures, businesses churning output, from family farms to tech startups, turning labor into lasting equity. Commodities, gold bars, silver stacks, even timber or rare earths that hold sway no matter the monetary overlord. These aren't gambles, they're proven lifelines. Portuguese traders, sensing the real's doom in the 1520s, funneled fortunes into Spanish silver caravans, preserving empires in exile. Dutch financiers, as Amsterdam dimmed in 1710, shuttled ledgers to London's rising banks, seeding the next boom. Post-war British aristocrats? They cashed out pounds for dollar stocks and U.S. realty, dodging the sterling plunge. Today, the sharpest minds echo that playbook. Hedge funds are stacking gold vaults in Singapore. Sovereign wealth pots in the Gulf are snapping up farmland in Australia. Even billionaires whisper about de-dollarization portfolios, a mix of crypto-hedged real assets, international equities, and inflation-linked bonds. Monitor the signals like a hawk, monthly IMF data on reserves. If dollar percentages nosedive, brace. Bilateral trade deals inked sans dollars. Red alert. Gold breaching $3,000 an ounce. The herd stampeding. As we stare down this crossroads, reflect on the arrogance of empires past. Portugal's sailors thought oceans eternal. The Dutch their canals unbreakable. Britain its fog-shrouded might invincible. They all learned the hard way. Currencies aren't divine, they're human constructs, fragile as paper. The dollar's tale is no different, scripted by the same deficits and delusions. But you hold the pen for your chapter. Ignore the pattern, cling to cash, and risk joining the footnotes of history's losers. Heed it, diversify, watch, adapt, and you'll weather the storm, emerging with wealth that endures. The global game's changing, faster than the headlines admit. The question isn't if the dollar falters, it's whether you're ready when it does. Your move. Imagine this. You're standing on the edge of a financial cliff, staring down at a chasm that's been widening for decades, invisible to most until the ground starts to crumble. What if I told you that the mighty U.S. dollar, the kingpin of global trade, the safe haven for trillions, isn't invincible? It's following a script written centuries ago, one that's toppled empires and rewritten the rules of wealth. And right now, in 2025, The smart money isn't panicking. It's quietly slipping away, just like it always has before the fall. Let me take you back, not to dusty textbooks, but to the shadows of history where fortunes were made and lost in the blink of an economic eye. It starts with the Dutch guilder in the 1700s, that golden era when Amsterdam was the heartbeat of world finance. The guilder ruled supreme, backing trade routes from the Spice Islands to the Baltic ports. But cracks formed, wars drained the coffers, inflation whispered through the markets, and the elite didn't wait for the flood. They shifted to Spanish silver. That's right. The very metal that once fueled the galleons of conquest became their quiet escape hatch. Fast forward to the Napoleonic Wars when the British pound sterling stepped into the spotlight. London bankers, sensing the guilder's fade, funneled their riches across the channel. They moved wealth to London, building an empire on borrowed stability. The pound endured, powering the Industrial Revolution and colonial expansion, but even it couldn't outrun the cycle. After World War II, as the empire crumbled under Reconstruction debts and lost colonies, the British elite did the same dance. They moved wealth to dollars and dollar assets, handing the crown to Uncle Sam in a deal sealed at Bretton Woods. And this is what smart money is doing right now, systematically, without fanfare, positioning for the next shift. No alarms blaring, no headlines screaming catastrophe. It's a methodical exodus, year by year, asset by asset, from bonds to gold, from treasuries to emerging havens. But why? Because beneath the surface of our modern markets lies a pattern, etched into the annals of 6 centuries. It's not some shadowy cabal pulling strings. It's economics at its rawest, a predictable rhythm of rise, strain, and inevitable decline for every reserve currency that's ever held the throne. Picture it like a 7-act tragedy, played out across 4 currencies before ours. The Portuguese real in the 1500s, the Spanish dollar in the 1600s, the guilder, the pound, and now the greenback. Act 1. A new power emerges, backed by innovation or conquest. Portuguese explorers charting unclaimed seas, Spanish silver mines vomiting riches. The world flocks to it. Trade booms, debts are denominated in that currency, and central banks stockpile it like a sacred relic. But Act 2 creeps in. Overextension. Wars, expansions, or sheer greed stretch the system thin. The Portuguese real buckled under endless crusades. Spain's dollar drowned in inflation from unchecked minting. Reserves dwindle, confidence wavers, but the show goes on. By Act 3, the cracks show. Higher interest rates to lure back investors, subtle devaluations masked as policy tweaks. The Dutch guilder hit this wall during their golden age, forcing those bankers to eye alternatives. We escalate now to the heart of the drama. Acts 4 and 5, where denial meets reality. The currency's architects print more to paper over deficits. Think Britain's post-war sterling crisis, where the pound clung to glory even as Suez exposed its frailty. Trade imbalances grow, allies start hedging, and whispers of alternatives echo in boardrooms. That's where the dollar sits today, deep in Act 5. Deficits ballooning past 35 trillion in national debt, sanctions weaponizing the dollar's dominance, and rivals like China and Russia building parallel systems, BRICS currencies, digital yuan trials, gold repatriation. It's not chaos. It's choreography from history's playbook. The tension builds in Act 6, the tipping point. Investors flee en masse, not in riot, but in calculated precision. Liquidity dries up, forcing desperate measures, capital controls, forced loans, or outright abandonment. The Spanish dollar saw this in the 1700s as British and French traders dumped it for stability elsewhere. Act 7 seals the fate, collapse, and transition. The old guard's wealth evaporates for the unwary. while the prescient thrive in the new order. The guilder vanished into obscurity. The pound became a regional player. Each cycle spans 80 to 110 years, a generational handover where the slow bleed turns torrent. Why does this matter now in 2025 as AI reshapes industries and geopolitics redraws maps? Because we're not spectators. We're players in Act Five's final scenes. The dollar's share of global reserves has dipped below 60%, the lowest since the 1970s. Central banks are diversifying. Russia's gold vaults bulge. Saudi Arabia flirts with yuan for oil sales, and crypto whispers of a decentralized escape. Inflation's ghost lingers from 2022's spikes, eroding purchasing power, while interest rates yo-yo like a puppet on strings. If history holds, and it has 4 times over, Act 6 isn't a quote 4. It's a probability edging towards certainty. The transition won't come with tanks rolling or markets imploding overnight. It'll be mathematical inevitability. Slow erosion, then swift realignment. By the time CNBC declares the end, the smart money, those Dutch bankers' heirs, will have long since pivoted. I've chased these threads across archives and trading floors, piecing together the puzzle that most economists gloss over in favor of quarterly forecasts. This pattern isn't prophecy, it's precedent. The Portuguese missed it and faded. The Spanish clung too long and fractured. The Dutch anticipated and pivoted. The British delayed but adapted. The dollar? It's in the crosshairs, and the global economy hangs in the balance. Wars in Ukraine and the Middle East accelerate the strain. Supply chains fracture under tariffs, and climate costs pile on like unseen debt. So as we stand here in 2025, with stock markets at all-time highs masking the undercurrents, ask yourself, are you the one shifting assets quietly or the liquidity fueling someone else's gain? History doesn't repeat exactly, but it rhymes. 7 stages, 4 currencies, now the 5th. The timeline is etched. 80 to 110 years from Bretton Woods in 1944 puts us squarely in the endgame. If this glimpse into the cycle has sharpened your view of the dollar's fragility, the web of global finance and the storms brewing, then you're ahead of the curve. Watch it unfold, because Act 6 is stirring. The reserve currency doesn't die in glory. It fades in numbers, ignored until undeniable. And when the transition completes, the world will have a new anchor. Will you be ready to weigh anchor with it? That's the real question, the one that separates survivors from the sidelined. Stay vigilant. The pattern is clear, and it's ours to navigate.